The broadcast is now starting. All attendees are in listen-only mode.
Hi everybody, welcome to this revision webcast. This session we're going to be looking at aspects of economic growth, which for most students is the change in real GDP over time. I have a slightly different definition. I want to focus on the distinction between short-term and long-run growth. It's quite an important distinction to make, and hopefully in this revision session over the next 15-20 minutes we can cover quite a lot of ground and you get a good feel for some of the growth dynamics for countries such as the UK in a constantly changing world economy. This slide is taken off the front page of the latest IMF, International Monetary Fund, World Economic Outlook. I just want you to look at the bottom right hand side. It talks about uneven growth. That's hinting that the rate of change of GDP varies very widely across the world economy. And underneath it, it says short and long run factors. And that tells us that when we think about economic growth, it's always good to make a distinction between what's driving the economy in the short term, for example, during an economic recovery, and what are the longer term factors affecting potential growth or trend growth, the productive capacity of an economy, and how that can be engineered in the long term. This IMF forecast made for some interesting reading. There's a lot of data here and you don't have to learn it, but if you look at the top, the IMF is forecasting that the world will grow in GDP terms by around 3.5%, a little faster than last year, and the growth will pick up again next year, 3.8%. Look at the variation within this table. If you take the advanced economies as a whole, they're not going to grow at that kind of pace. They're going to grow perhaps at 2%, 2.5%. The United States leading the way there. The Eurozone, having experienced a recession in 2013, it's starting to pick up. The growth rate is beginning to recover, but it's growing at less than half the rate of the world economy. Even Germany, biggest economy in the Eurozone, is struggling to grow at 2%. Italy and Spain in the doldrums. The one bright spot could even be Greece. There were some people thinking that Greece might grow more quickly in 2016 than the UK. That'd be interesting. Kingdom economy had a good year in 2014, grew by 2.5%. IMF is forecasting something similar this year, maybe a little slower in the sort of post-election year 2016. Overall, the advanced economies growing by about 2.5% per year. And contrast that with the growth rate of emerging market or developing economies. They're growing much more quickly. And many of them are in sub-Saharan Africa. I think they have 7 of the top 10 growth countries in the world this year. Down at the bottom of the table, 2 of the BRIC countries. Also, I forgot to mention Russia. Russia is likely to have a severe recession this year, sanction biting, collapsing currency. They may lose 4% of their national output this year. China having grown at 9-10% for the best part of 20-25 years, is forecast to see a slowdown in growth to around 7%. Indeed, the IMF is forecasting that India will grow more quickly than China in 2015. That represents quite a remarkable turnaround for the Indian economy. So what is this distinction I suggested I wanted to make in this session between short-run and long-run growth? Well, short-run growth, to my mind, is basically the stages of growth, so the rates of growth one would expect to see at different stages of the economic cycle. Essentially, what drives the growth rate of GDP in the short term are cyclical changes in the components of aggregate demand. C plus I plus G plus X minus M. It's really the demand side of the economy and demand side policies such as interest rates or taxes or government spending. Those are the key factors affecting the short-term growth of the economy. Another factor influencing short-run growth is the aggregate supply function. What's happening, for example, to wages, or what's happening to short-term changes in business costs, for example, the carbon price, to give just one example there. So the key to this is that short-term growth is driven by changes in demand and short-run supply. And also it's affected by the external shocks that happen almost without being able to predict it properly. Changes in oil prices, changes in the price of essential commodities are the kind of external shocks I'm thinking about there. So macro policy changes, external shocks, ADAS, they are the factors driving the short-term growth of the economy. Either moving from a point inside the PPF, for example, closer to the PPF and using up spare capacity, or perhaps a shift in the aggregate demand curve affecting the level of real GDP. Now, what about long-run growth? This is really what economists think about when they talk about the growth rate. And notice on the right-hand side here that the concepts here are subtly different to those on the left-hand side. When we're thinking about potential growth or trend growth of the economy, that happens when the productive capacity of the economy is increasing. And that's really always engineered by supply-side policies and by supply-side effects. So, for example, can we achieve significant increases in productivity of labour and capital? Can an economy move into new areas of technology, pushing out technological frontiers? Is an economy able to grow its labour force and improve the quality of the people they have available? And crucially, can an economy sustain a sufficiently high rate of investment in technology, in buildings, in machinery, to be able to sustain a higher long-term growth rate? This is the distinction that I think is really quite important to make. The Bank of England forecasts what they think is going to happen to GDP growth over a 2-3 year horizon. And the darker the green section in this slide, the more likely is their central forecast. And you can see from this chart that the Bank of England is not forecasting a recession. They think that's highly unlikely, despite the uncertainties. But they're kind of, the central forecast is that growth in the UK will probably edge down to closer towards 2-2.5% in the next 2 or 3 years. It suggests the recovery is fairly durable and sustainable, although there'll be a lot of uncertainty obviously from year to year. So these growth factors, what are the factors that really determine the short-term growth of the economy? One of them is interest rates, the policy rate set by, in our case, the Bank of England. Another factor is the exchange rate, really important because the exchange rate affects prices of imports and exports, and it affects the ability of our producers to sell goods and services overseas, and for domestic producers to be able to meet the demand of home consumers. The exchange rate in the UK is an important issue. The yellow line here shows an index of the pound against the euro. It's rising. That suggests that the pound has been appreciating against the euro in 2014, 2015. That could make it harder to sell our exports overseas to Germany or Italy or to many of the other Eurozone countries. If you follow the maroon line on this chart, well, that's been falling. And that suggests the pound has been depreciating against the US dollar. And that's going to make it easier to export to the United States and to other countries which use the dollar. It's also going to make it more expensive to import things like dollar-priced commodities. Follow the blue line, which is the combination. That's the overall value of the pound. The pound has been appreciating generally in the last 2 or 3 years. So it's slightly harder for our export businesses to get their goods and services sold in world markets. That could be one factor behind the rising trade deficit at the moment. Another key short-term growth factor is fiscal policy. And I'm sure you've been following the debate in and around the election about the coalition's fiscal austerity program and what's the best policy for cutting the deficit, how far and how fast should the deficit be cut. These decisions on government spending on tax, they have a big effect on the growth rate. And likewise, the UK is an open economy. It trades with the rest of the world. Nearly 50% of our exports go to fellow European Union countries. So the economic cycles of other countries have quite a big effect. I mentioned before the external shocks. Commodity prices, the price of oil has more than halved in the last year. The price of metals and foodstuffs are also falling. and Britain is a net importer of those things. Is that helping our growth rate into 2016 and 2017? Here's the example. Follow the green line here, the collapse in the price of oil, particularly in the last half of 2014, although the price seems to be recovering a little bit since. But more generally, price of agricultural goods and metals have also started to decline, albeit from high levels. The general point, really kind of essential argument, is that short-term growth in an economy is significantly influenced by the state of business and consumer confidence, what Keynes called animal spirits. And that's that ability, that willingness to get out there and buy a new car, to say yes to some home improvements, or for business to employ some extra people, or to give the go-ahead to an investment project. Confidence is a key factor driving the short-term growth of the UK economy. And we can show this in an ADAS diagram. At some point in the exam, you're going to be using some analysis. What I've shown here is just a shift in demand, for example, a rise in exports or an increase in consumption, and the impact that has on GDP. That will be a kind of cyclical rise in demand, leading to an expansion of real output. Now, what about the long-term factors? So these are the key things that drive the long-term growth of the economy. And foremost amongst them is investment. Countries need to invest, absolutely critical. They also need to research. And two of these things for the UK, they're not particularly positive. Investment, we invest around 15 to 16% of our GDP in new capital. Now, to put that in context, in the United States it's over 20%, in South Korea it's closer to 25%, and in China it's nearly double that, nearly 50% of GDP. Now, we're never going to get to that level, and perhaps we shouldn't, but the UK tends to underinvest in new capital, and that's going to hold back our long-term growth rate. And in terms of research and development, again, the UK lags behind other countries. R&D in Britain is less than 2% of GDP, whereas in a country such as Finland, it's closer to 3%, and in countries like South Korea and Israel, it's over 4%. These could be two factors you could mention holding back the long-term growth of the economy. And fundamental to long-term growth is productivity. Famous economist Paul Krugman once said, productivity isn't the only thing, but it's pretty close to being the only thing. This, to my mind, is the absolutely essential point of this webcast. If countries want to grow, they have to improve their productivity, measured by output per worker, output per hour worked. Various other ways you can look at it. Productivity, a measure of efficiency, is crucial to getting more output from the inputs you have. It's a key long-term factor. And linked to all of these things is the pace of innovation. Does an economy have the Facebooks, the Snapchats, the Alibabas of this world, the Samsungs, the Apples? Does a country have sufficiently innovative companies producing new products, creating new processes, providing the export dynamism that will drive an economy forward in the future? You need inputs, you need capital, you need ideas, you need people. So the labour supply is going to be a key factor affecting the long-term growth rate of the economy. And that brings in all kinds of issues to do with education, university tuition fees, migration policy, and to the long-term demographic factors. And then I suppose this is a kind of catch-all point, but you need people prepared to take a risk with ideas to start up businesses, and the future growth seed of the economy is the enterprise agenda. So again, in the UK at the moment, huge interest in entrepreneurship, in startups, in Silicon Valley style enterprises across the UK. And there's some good news there, that Britain is becoming well known around the world for having a startup mentality. Very, very successful startups. We just had the first $1 billion valued startup in the UK, Shazam. Very, very successful business, and I'm sure you can find your own examples. How would you show long-term growth? various ways. One is the traditional PPF diagram. So an increase in productive capacity causes the PPF to shift out, and that allows the economy to move to a high level of production. And then another way is to show long aggregate supply. Not every exam board asks you for the LRAS curve, but here we're showing a shift in LAS1 to LAS2, and an increase in the productive potential of the economy. That means the supply capacity has increased and allows the economy to operate at a higher level of demand. Key point I want to make is that long-term growth in most economies is driven by supply side competitiveness. If you can get that right, you're a long way down the pathway to achieving sustainable, durable economic growth. A2 students may be familiar with something called the Howard Dillinger model. Don't worry about it if you're only doing AS. The Howard Dillinger model suggests there's a link between savings and investment. That if the country can save more, that provides a flow of funds to allow increased investment. If investment goes up, you have a bigger capital stock. If you have a larger capital stock, you can increase your national output per capita. And if that creates more incomes, for example, for the multiplier effect, then people have more opportunity and more potential to save. Investment is certainly important. It's not the only factor, but investment is one of those topics at AS you simply have to revise because it's going to come into the discussion at some point. Investment, of course, is so important because it has demand and supply side effects. So if you're building new motorways or building new hospitals, then that's actually a demand for construction equipment. It's a demand for steel, it's a demand for technology. So investment creates demand for capital goods. It also allows businesses to scale up their activities and become more competitive, both in home and domestic markets. It's a key factor behind export-led growth. The example in the bottom right of this slide is South Korea, where strong investment demand has helped to create the likes of Samsung, LG, and other South Korean global manufacturing businesses. And crucially, even in low-income countries, middle-income countries, just subtle improvements in the capital stock, for example, in farming, can have significant effects on farm yields, on productivity, and raising incomes. So savings are important. However, you have to be slightly cautious and careful with this. Many countries, they simply don't have the income to be able to save, and a lot of countries run into savings gap problems. That means they're increasingly reliant on aid or on foreign direct investment from overseas, or they have to borrow externally in order to fund their investment. I said a lot about capital investment. That's certainly a key driver of growth. We should always remember that human capital, the skills, the experiences, the flexibilities, the aptitudes of the workforce is really important as well. Human capital is sometimes described as the quality of a country's labour force. And if you can achieve improvements in that, it's a great way of increasing productivity and making better use of the capital equipment you do have. So although countries can raise their investment rates and they can have more capital per worker, we call that capital deepening. Unless you have the right human capital as well, you're not going to make the most of the capital you have. This suggests that long-term growth requires a balance between physical capital investment, new machinery, new technology, and also human capital investment to give the economy the skills and the aptitudes to make best full effective use of the capital you have. What's stopping countries growing? We see growth rates around the world that are very uneven. This final slide in this presentation just takes you through some of the key threats and the key barriers to growth in many countries. Growth is not inevitable. Take the example of Greece, which has suffered 6 consecutive years of recession. They've lost over 25% of their national output. Per capita incomes have fallen by a generation's worth in the space of just a few years. Growth is not inevitable. Oftentimes there are barriers to growth in an economy. And this slide just takes you through some of the potential threats to economic growth facing either a developed country or an emerging market economy. One of the key threats, which to some economists is also an opportunity, to many is a challenge, is the aging population. This chart is taken from a recent World Bank report and tracks the population aged 15 to 74 as a share of the total. And you can see the downward trajectory of this chart. That by, for example, if you take China, whereas at the moment around 75, 76% of the population is aged between 50 and 74, by 2060 that's going to be almost down to 70%. And for a country like Japan, from 1995, where 3/4 of the people were effectively of working age and a bit beyond, that's going to fall down to 60%. So for many countries, an aging population is going to be a significant challenge to their future growth. Second key barrier is instability. We've seen in the last 5, 10, 15 years what financial crises can do to countries such as Greece, and there are many others besides. I just wanted to share with you this remarkable chart, which is taken from the work of Draymond et al. 2012, and it plots the degree of financial instability and economic instability. You'll be familiar, I hope, with the idea of the economic cycle, the fluctuations in GDP from one year to another. And that's shown in this chart by the kind of brown, strong, dark red line. And you can see that across the United States, for example, there's been an economic cycle, ups and downs, and what have you. The blue line shows the financial cycle, variations in things like credit levels, house prices in real terms. And you can see that financial cycles tend to be more volatile than economic cycles. Can you see that change since about 1971? Every time we have a financial boom and bust, it seems to get bigger. Dot-com crisis around the turn of the last century, the financial crisis of 2007. What I take from this chart is that financial cycles are becoming more volatile. And ultimately, financial instability, I think, is the biggest single threat to economic stability. But there are others. The third on my slide here is out of disruptive technologies, what Schumpeter called creative disruption. So countries that are used to being on a particular growth path can sometimes face an unexpected challenge. A country develops a new advantage which takes away their export markets. New businesses emerge which threaten and challenge the profits and the jobs of well-established monopolies. Here's one of my favorite examples, taken from a tweet just a couple of weeks ago. This year, Uber has become the world's biggest taxi company, but it doesn't own any vehicles. Facebook has become one of the world's biggest media companies. It doesn't create any of its own content. The Chinese company Alibaba has become the most valuable retailer in the world. It's bigger than Walmart, but it doesn't have any stock. And Airbnb has become effectively the biggest hotel company in the world. It doesn't own a single room, doesn't own any homes. Now, these are companies 10, 15 years ago barely existed, which are now becoming dominant world companies. The world is changing very rapidly. You can't take growth for granted. And there are many other barriers and many other threats. Inflation can get out of control, and that can lead to problems. I think two good examples there would be what's happening to Brazil, which is slowing down very rapidly. Inflation of 7%, growth of only 1%. Economists call that stagflation. And more recently, countries like India, where high inflation has been a major barrier to their growth rate. And then at the other extreme, we have deflation. The deflation in Japan, deflation in Greece, or latterly in Spain, the extent to which deflation is a challenge to economic growth because of its impact on debt levels and people's willingness to spend. And then towards the end here, three fundamental factors. These are almost topics in their own right, and we'll probably cover them in future webcasts. But we know that inequality of income and wealth has become one of the dominant economic, social, political issues of the age. To what extent is the chasm in income inequality between rich and poor a factor holding back the growth rates of countries such as the United States, as China, of the UK. Instability in politics could hold growth rates back, and fundamentally, the threat to our global commons, water scarcity, loss of biodiversity, climate change, all those environmental threats which can fundamentally hold back the natural factor resources upon which growth depends. So this slide tries to capture for you in revision some of the factors which can limit the rate of growth of GDP in one country or in a region. Growth is not an inevitable process. Please do check out our website if you want some more resources on growth. It's a key topic. Many resources on there, from study notes to revision presentations and revision quizzes. Just go to our website, it's listed there, and that will take you very speedily through to all the resources that's available. If you want to follow me on Twitter, I'm on tutor2_econ. I'm really happy to continue the conversation. But thank you for listening in and joining in on this revision webcast on aspects of economic growth.